Good day. This is Aging Maven Aficionado Amy K. Gaskin, and today I'm joined with Randall Watsek, and we're going to talk about investing through the ages. Welcome, Randall.
Oh, thank you. Thank you, Amy.
I hope you're doing well today. Why don't you tell everyone a little bit about yourself?
Sure. I'm a financial advisor at Raymond James, and I've been in money management for the last 26 years. Started where I was born and raised in California at a commercial bank managing a portfolio of loans. And then when I went to business school, I switched over to the equity side, and I've been in equity management for most of that time. Started mainly on the institutional side as a research analyst and portfolio manager for pension funds and endowments and things like that. And I love the investing side. I mean, this is something I've thought about even since high school. I was fascinated by compounding tables. You could tell I was a bit of a nerd, I guess, in how
Some people are really good with numbers, and people are attracted to that, and we need people like you.
Yeah, and so I love the investing side, but what I didn't love on the institutional side was that I didn't have client relationships, and I was just sort of an employee in a large organization, and I just found more meaning and more fulfillment in actually having client relationships and helping people make changes that could improve their lives. And so that's why I moved over to the wealth management side of the business, where I could continue doing the investing that I love doing, but also have a direct impact on people. And so that's what I've been doing the last 26 years.
Wow. Well, why don't you tell us a little bit about what we want to talk about today? What do you want to do?
Sure. I think this is a pretty timely topic, and I've seen a lot of effects on people in the last month, especially starting September when the market was going down and interest rates were going up, that people, especially in their 70s and 80s and even 90s, were taking on a lot more risk than they expected to be taking on. And that's because a lot of people, even a lot of financial advisors, don't understand the various kinds of risks that people can take. Everybody's well aware of big recessions and everything can hurt your stock market portfolio. But the interesting thing about this year was that 20 and 30-year treasury bonds, which a lot of people think of as the safety part of their portfolios, have been down even more than the stock market. And that's because while they don't have any recession risk, they have a high amount of interest rate risk. And with how fast interest rates have risen, the long-term treasury bonds have gone down a lot. And so I was just talking with a couple where the man is in his early 80s and his wife is in her early 90s. Their portfolio is down about a third.
And a lot for someone that age.
Yeah, and he was just astounded because he had told his advisor that he can't afford to take a big risk at this age, and his advisor put him in what the advisor thought was a fairly conservative portfolio with a lot of fixed income, but the fixed income was down a lot too. And so this couple, they were just wondering, how are we ever going to recover from this in our lifetime?
Right.
To recover from a third loss in your 80s and 90s, I mean, it takes time. It takes 5-10 years, and you just have a shorter time horizon with that. And so when I was looking through the portfolio, I just saw a lot of things that I just felt were really inappropriate for the age, because within any asset class, whether it's bonds or stocks, there's a whole spectrum of what's risky, what's less risky. So within bonds, yes, bonds can be very conservative, but they can also be risky. If you have bonds on the shorter term side of things with more adjustable interest rates and more inflation protection, they're really very safe types of investments. But if you have it heavily in 20, 30-year bonds, then they can be just as risky as stocks in certain environments. So I think that's the thing, to understand risk, not as just like a single thing, but as something that varies for different circumstances. There's interest rate risk, there's recession risk, there's geopolitical risk, like Russia coming in and invading Ukraine. And then there's just things that happen out of the blue, like COVID, that happen out of the blue. So you have to think about a multifaceted way of looking at risk and how you could protect your portfolio from different kinds of risk. So you can never be risk-free.
Right.
There's always some sort of risk, but it's important to understand what kind of risk you're taking. A lot of people were very surprised to find out they were taking a lot more risk than they expected.
Well, I would imagine that somebody taking a risk in their 30s or 40s or 50s is totally different than someone taking a risk in their 60s, 70s, 80s, and 90s. And even if you're even younger, it's different depending on where you are in life and what your goals are, correct?
Right, exactly. I mean, if you're in your 20s or 30s or even 40s or 50s, you still have a good 30, 40-year time horizon ahead of you. And what will give you the best return and protect you from the longer term risk are one kind of category of investments. But if your time horizon's 5 to 10 years, maybe 15, 20 years, it's a totally different category of risks that are relevant for that time period. And so just as an example, like what you were saying, Amy, if you're in your 30s or 40s, yes, you can afford to invest in more like emerging growth companies, things like that, that maybe they're not profitable now, but they might pay off 5 or 10 years from now. That's a risky type of investment, but at that age, you can afford to wait until things pan out. Whereas when you're in your 50s or 60s, then you have to start thinking that you can't take those kind of emerging risk anymore. Maybe you switch to more well-established companies that are already profitable, that are already paying a dividend and things like that. And then as you get into your 70s, 80s, 90s, then it's more about what will keep my money safe in different periods. So you definitely want to bucket that sort of risk. So you want, say, 5 years of expenses and very safe short-term kind of investments, no long-term bonds, no stocks for that bucket. Maybe you have a little bit in for long-term growth if you have a long life expectancy, or if you want to leave something to your kids or a charity or something. But you sort of have to customize how much risk you're taking for what kind of goals you have and where you are in life.
Now, how often would somebody, depending, I would imagine it depends on how old they are and their goals. How often do you meet with clients, or how often should a client review their portfolio so they know that we should change things?
Yeah, I would say everybody, regardless of the market environment, should review their financial plan and their investment strategy at least once a year, because things change. I mean, plans are not set in stone. Like there's that saying, we plan and God laughs. So right. Things change, either in the market or in your personal life. Maybe there's a situation with your job or health or whatever. So things change, and I would say at least every year it should be updated. And if things do change substantially in the meantime, you should also update it more frequently. But yeah, I would say no matter what, you should do a review at least every year.
Now, that couple that was in their 80s and 90s, how long had it been since they had someone truly look at their plan and change things?
Well, this is the interesting thing, and the financial industry has evolved a lot over the last 30 years, and the traditional way of sort of having a stockbroker pitch you stock ideas or fund ideas or whatever has changed into a model of more financial advisory, where you do a plan and you consider the life circumstances and what's appropriate for that. But they were still under sort of that traditional stockbroker type of situation where they didn't really have a plan that was suitable for their age. They just sort of had an investment portfolio and somebody managing the investment portfolio. And that's important, but I think you can't do a great job managing a portfolio unless you've already done a plan first to know the full circumstances and the full goals. So they hadn't really had a recent plan updated as far as I know.
Wow. Any other stories that you can advise people on, that from your experience, that would help them in trying to do something with their money?
Yeah, I mean that's one story. I mean there's a lot actually. I see for example, there's a woman who is in her mid 80s. I looked at her portfolio. She's actually mainly in growth stocks. She has almost no fixed income. She doesn't even have many dividend stocks. It's mainly growth stocks. And while those did very well for her when she was younger, and so that's why she likes them, they took a massive loss this year. Growth stocks are down 30%. So that's another example.
It's a big hit for a senior.
Yeah, I mean, the thing is, people sort of learn from their experience, and so if you had a strategy that worked well for you when you're in your 30s and 40s and 50s, you tend to like that strategy, and people might not change it over time. But what worked in the past might not be appropriate for where you are now in the future. So that's something I see a lot, where people sort of have a strategy that's worked for them, but it's no longer the best strategy for where they are in life.
Right, because the world is changing quickly and faster now than it ever has.
Right, the world's changing, their age is changing, their health is changing, different things like that. I mean, there's another. The biggest thing, though, and it's not just about investment strategy, because it is true that different strategies can perform differently under risk circumstances over time. But the most important thing, actually, for most people, if you have time, is to fix the fundamentals. So what that means is, if you haven't retired yet and you're still accumulating, to get the savings rate down, because even though you live comfortably now, and maybe I've known people who planned on never retiring just because they love working.
Right.
You know what happened? They had an accident, and then they weren't able to work anymore. They're sort of forced to retire. But because they had planned on keep working, they hadn't saved enough money over time. So I think that's something that's very important to avoid hardship if something happens that you don't expect.
A rainy day fund, something, preparing is, it's better to prepare,
Right.
In case something happens.
Yeah, there's a book I read recently called The Psychology of Money, which I thought was very good. I highly recommend it.
Mm-hmm.
And he was talking about the value of saving. Most people think of savings as you're saving for some specific goal, like you're saving for retirement, or you're saving for college, or a new car, or buying a house, or whatever. But saving for the sake of saving is valuable in itself, because what you're buying is not some specific thing, but you're buying freedom and independence, so that you have options. So you may not have any specific thing that you're saving for, but having this amount of liquid reserves available means that you can say no to things that you don't want to do. You can maybe take advantage of a distressed sale or something that comes along, things that you couldn't predict. So I think having those fundamentals are, if you still have time for them, are more important. And if you no longer have time for that, then that's when you have to be really careful about how you plan and what kind of risks you take and things like that.
Right. When you talk about saving for the future, should you put a certain percentage of your income away into savings or investments every month? And would that percentage be different depending on what age you were?
Yeah, I mean, it's hard to give one universal rule of thumb, because everybody's circumstances are different. Like if say you come from a family that already has some wealth, maybe you feel less need for that, or say that your income far more than covers it, you don't really have to think about the percentage that much. But I would say like everybody should at least try to, at a bare minimum, try to match or whatever their company's matching is for the 401k. But personally speaking, I've always maximized my 401k plus saved more, but that's my own circumstance. Everybody's different.
Right.
So I would take into consideration everything, and it depends on your life cycle too. Like, it's hard for a lot of people to save after they're married with kids. They have childcare expenses and all that. But the interesting thing is, even for seniors who are retired, who are on Social Security, and that maybe they have a little extra income from other things, it's a good practice for them to put aside part of their income too, so that they do have it for rainy day sorts of things, or an unexpected medical thing that comes up that's not completely covered by Medicare or whatever. It's always good to save even when you're in the retirement phase. So that's what I would say. But I understand everybody's circumstances are different.
Right, but planning ahead is the best, because if all of a sudden your tire goes on your car, or hurricane comes through and it broke a couple windows and you have to get that replaced, and sometimes it takes FEMA a long time to get to you. I was talking to one woman that she lives just north of Fort Myers, and she's got over $20,000 of damage on her house. Wow. And she's waiting for FEMA to come by. The storm was a couple weeks ago. I think it was 2 weeks ago today. And she's still waiting for FEMA to come to assess, and which means she or her husband have to be home 24 hours a day until they come. So it's totally affecting like a lot of things. And so if you're a senior, there's a lot of seniors that were that couldn't evacuate for the hurricane. And one senior stayed in his own home. He had no food and no transportation because the car got flooded with water, and his house was flooded with water. And they actually came in by boat to get him, but he didn't have any money set aside, so he couldn't wait. He couldn't go out to a shelter. He couldn't do all those things, and that's why if you have a little money saved, you can at least go to a hotel, be safe, or pay for a Lyft or an Uber or a cab to get to a shelter. So seniors have to understand that you have to have a rainy day fund. So that's good advice.
And the other thing is, for those who can afford to have a home and were lucky enough or smart enough to pay down the mortgage before retirement, a lot of people might look at this in a strict economic sense that, okay, before you could get mortgages at 3%. Of course, now it's like 6-7%.
Right.
But before you could get them at 3%, you could do better than that on getting higher dividend yields or interest rates on something. So why pay off the mortgage? But there's a big advantage to doing that, in that it reduces the risk that you have to come up with the mortgage payment on a daily basis. And so even though the interest rate might be low, you still have all this cash outflow that you have every month. And so having that paid off, it lowers your risk profile in retirement, and it's basically a risk-free return. And the other thing is, if you are in that situation, and say that you're in your 80s or 90s and you develop dementia or something. There's a woman I know who is 93 and she developed dementia. Her savings had run out, but she had paid off her home already. And so she could use the equity in her house to fund ongoing care at a nice place, rather than being forced to go into a Medicaid type of facility, which really
it's not advisable. So many, I've been in senior living over a decade, and I talked to many families, and the senior themselves prepared for assisted living. They were veterans. They were this, they were that. They had investments that could absolutely take care of what it would cost at a nice assisted living, and still leave some funds for their adult children. And then the adult children come along and they want the money. And they think that, and then the adult child, because the adult wants to give their kids whatever they can. And so the next thing they know, they're in a Medicaid place, and they realize you wouldn't want to have your dog be there, let alone your mom.
That's horrible. I mean, that's a very selfish thing.
It is, but it happens. And so I always try to talk to seniors and educate them. Take care of yourself first, because that's what your money is for. And make sure that, you go to, the best that you can afford. And then there are a lot of nice places that they're nice. And so if you start out private paying, after 2 years, you can get on a Medicaid waiting list and stay in that same community. Sometimes you'll meet a friend, and that friend will also get on Medicaid, and you guys can be roommates and save money beforehand. So there's a lot of ways to make sure that you prepare for the future and plan and have the money to do what you want to do. But you need to plan ahead.
Yeah. And I think this is really important, because some of those private pay places are great. I mean, it's almost like staying in a luxury hotel.
Yeah.
If it's a really nice place. And it makes a big difference if you're getting a good quality of care versus not. I mean, one, just for your happiness, I mean, you'll feel much better on a day-to-day basis if you can afford to be in a quality place like that. But also, there's a big difference in life expectancy, even of people who have money and can pay for good care, and people who don't. From both the perspective of quality of life and length of life, planning ahead like that makes a big difference.
Yeah, I spoke to a woman this morning, and she, her mother had Alzheimer's for 11 years and spent 9 years in a nursing home. And all of a sudden, she realized that they gave her the wrong medicine one day, and she actually slept on the floor of her mom's nursing home room for the last year of her mom's life, and had a big eye opening. And she said she didn't like it, and she was paying decent money. They were paying over $8,000 a month, and she was one of the top 3 in the country supposedly, which wasn't sure with 8,000 because that's kind of a low fund for being one of the top.
Yeah.
But they were known for really good care, which is really good. But they're not all perfect, and so you want to go to a place that's going to be transparent, et cetera, because you don't want to have to pay all that money and then move in with their mom into a nursing home. That's just not what people do. But she obviously was dedicated to her mom. But they were happy that they had the wherewithal. She says, I couldn't imagine not having the wherewithal and going to a place that was even substandard than that.
Yeah.
But that particular place paid a $1.2 million fine after her mother passed away. $1.2 million it cost them. And so that's one of the reasons why I got involved with Family Care Space, because they actually monitor a senior living community to make sure that everyone's on the same page and checks and balances. But yeah, we want to make sure that seniors are protected and they have the money that they have to do what they need to do.
That's great.
Any other advice that you have for us today?
No, I would just circle back to the beginning thing, and that's if you haven't done a plan already, to do a plan that takes full account of your circumstances and where you are, your health, your age, your financial circumstances, all that, and to update it regularly. And also to think broadly about risk. Risk is not like a statistical formula or one thing called risk. There's a lot of different kinds of risks that people face, and it's very important to think about how you're protected from different sorts of things that could happen to you. Right.
Well, that is great. And anytime you want to come back on and talk to me again, I'm happy to have you on.
Thank you.
Yeah, thanks again for coming on today, Randall, and talking about us for different investing strategies through the ages. And again, this is Amy K. Gaskin, Aging Maven Aficionado here at Ask Amy About Aging. And today we were talking with Randall Watsek. So thanks again. And I'm going to have Randall's contact information in the comment section of the video, so you can get a hold of him if you have any questions. And so that's great. So any final words, Randall?
Well, thank you for having me, Amy. It was a pleasure, and I appreciate both hearing your experiences in the senior care space and sharing what I have to offer as well.
Oh, thank you very much. Thanks again. So bye, everyone. Thanks again. Have a great day.